ETNs, or exchange-traded notes, are often confused with ETFs. While they do share some similarities, they are different. An ETN, or exchange-traded note, is a type of debt security that is traded on the stock exchange, much like bonds. However, unlike a bond, an ETN is not issued by a government or corporation. Instead, it's issued by an investment bank. An ETN works by giving investors exposure to a specific underlying asset, such as a commodity or an index. The investment bank issuing the ETN promises to pay the investor a return at maturity based on the performance of the underlying asset. This also means that, unlike a bond, there are no regular interest payments. That said, there are some covered call ETNs which work very similarly to covered call ETFs and do pay out regularly the income from the covered calls. One example, although not a recommendation, is USOI. It's issued by Credit Suisse and sells covered calls against crude oil. If you wanted to invest in crude oil and were looking for better returns than just the growth or decline in price per barrel, something like USOI could make sense. In either case of a regular or covered call ETN, the bank also charges an expense ratio, which is how they make money from the note. It's important to note that, like an ETF, if you invest into an ETN, you don't actually own the underlying assets. You just own exposure to those underlying assets, since the fund, in the case of ETFs, or the bank, in the case of an ETN, is what actually owns those assets. One of the advantages of an ETN is they provide investors with a way to gain exposure to an underlying asset that may be difficult or expensive to invest in directly. For example, an ETN may give investors exposure to a commodity like gold or oil without the need to physically hold or store the commodity. Because regular ETNs don't pay dividends or interest, there are also some tax benefits. Since you're just buying and selling these notes, the profits at the point of sale are taxed as capital gains rather than regular income. Whether it's taxed as short-term or long-term capital gains depends entirely on how long you hold the notes before selling. Another advantage of ETNs is they're traded on the exchange, which means they can be easily bought and sold like a stock. This can make them a convenient investment option for those who are looking for flexibility and liquidity. ETNs tend to have higher returns than your average dividend stock. This is due to their risk being higher than that of traditional ETFs or dividend stocks. This brings us to the potential drawbacks of investing in ETNs. First, and in my opinion, most important, despite the fact these ETNs are issued by investment banks, they are not FDIC insured. This means the bank can default on that note and you would have no recourse. Or the bank could fail and you might be left holding the bag. The bank could also just choose to delist the ETN entirely at any point, making it impossible for you to sell. Another potential disadvantage of ETNs is they may be subject to tracking errors, which means the return on the ETN may not perfectly match the return of the underlying asset. Knowing this, you might ask yourself if you should invest in ETNs. Before deciding to invest, it's important to fully assess whether a particular ETN is right for you. Let's use USOI from earlier as our example here. The underlying asset, crude oil, is still currently a necessity. Although, with the car market transitioning over to electric vehicles, demand could slow significantly prior to USOI's 2037 maturity date. This means there's a chance the asset value could crash at any point prior to maturity. This ETN is issued by Credit Suisse, which had its own issues last year, adding the additional risk of possible default or USOI possibly being delisted. Price action on USOI since IPO isn't looking too good either. As you can see on this chart, the price took a nosedive in early 2020 with the pandemic crash and still hasn't fully recovered. Dividend payouts on this ETN have fluctuated but are currently advertised to be 40.42%, making them some of the higher dividends in the market. Despite the massive yield, this ETN carries a significant amount of risk, in my opinion, enough to outweigh the high dividend. If you do decide to get into ETNs, tread carefully and do your own due diligence first. If you have very high risk tolerance and only care about the highest returns, then this might be worth considering. However, if your risk tolerance is lower, even if you're looking for the highest income, it might be better to take your capital elsewhere. If you liked this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video. As always, this is not financial advice. Do your own due diligence before investing into anything.